Hi guys, Paul at Forex Trading Tips here with another educational video on Forex trading and spread betting. This video lesson is for those of you who are either a beginner, a losing trader, a trader who jumps out too early and doesn't maximize on your profits, or if you tend to close positions down through fear of losing only to see it go the way you bet on it going in the first place. If you're any of these, then stick around until the end, as this information really can help you to become a more consistent, profitable trader and spread better in the Forex market. Now, what I'm going to talk about in this video is the importance of having some basic knowledge regarding different time frames and their interrelationship, which can often be a little confusing, especially for beginners. And if you aren't a beginner, as I've already said, it's still a good thing to have a little reminder, especially if you're a struggling and possibly an overall losing trader. I'll also be discussing the best time frame combinations, what time frames suit what personalities the best, as well as different trading styles. Now, although what I'm going to talk about here may seem generally very basic information to many of you, it's often forgotten or overlooked completely. I mean, it really is, and this can be the difference, in my opinion, between a winning and a losing trader in the long run. I know when I started to do this and implement it into my trading, things started, to take a good turn for the better. Now, I'm not going to get into all the actual individual candles and candlestick patterns and formations and their meaning here, okay guys, that's for another video. I'm going to just start off, by highlighting some candles on the higher time frames to show how much, dropping down to show how much price action or movement, which is basically exactly the same thing. Price action is the movement of price, how much there can be inside each individual candle when viewed in lower time frames, and how this can help us hopefully in our trading once we become aware of it, depending on the type of strategy you implement in your trading and spread betting. Okay, so let's start on the at the monthly time frame. For those of you who are unclear on this, particularly if you're a beginner, the monthly time frame simply means that each candle represents 1 month's worth of price movement, also called price action, as I've said. So each of these monthly candles takes 1 month to form before the next one starts. So each monthly candle takes a month to form before the next one starts. That's the monthly time frame. If we look at a single monthly candle and highlight it and then drop down to the weekly time frame, where each candle takes 1 week to form and represents 1 week's worth of price action, we can see that the previously highlighted monthly candle is still highlighted, but now it's broken down into individual weekly candles, as we are now on the weekly time frame. So from this, hope you can see the fluctuation in price inside a single monthly candle. So if you look at a monthly candle, then you break it down as we have here, you can see how much movement there really is inside that monthly candle. So we can see, the price action of that month in a little more detail, looking at it like this. If we then drop down to the daily time frame, where each candle represents 1 day's worth of price action and therefore takes 1 day to form, we can see the previously highlighted monthly candle still, but now it's broken down into individual daily candles, as we are now on the daily time frame. So again, you can see just how much price action and movement there is inside 1 month's worth of trading when it's broken down into daily candles. Normally, looking at a month, as I've said, you just see that 1 candle, but when it's broken down into daily candles like this on the daily time frame, we can see that price action of that month in more detail. So let's take a look now at the amount of price action and movement there is in 1 day when we highlight a day's worth of price action, which happens to be the 7th of May 2020. We're on the Great British Pound, Aussie dollar, and we're going to drop down to the 1 hour, the 15 minute, the 5 minute and 1 minute time frames also. Here you can see, that whole day's price action on the hourly time frame. So we've got that day, and now it's on an hourly time frame, showing 24 candles. Alright, so it's from midnight to midnight, where each candle takes 1 hour to form. So you can see there's quite a lot of movement in that 1 day, Well, it's broken down into 24 hourly candles. Here's that same day still highlighted, but on the 15-minute time frame, where each candle takes 15 minutes to form. And again here on the 5-minute time frame. So you can see there's quite a lot of price action taking place in that day. This is on the 5-minute time frame. Here's the same day once more on the 1-minute time frame, where you can clearly see a lot of price action has taken place. You know, it's up and down a lot, isn't it, during the course of a day. Now, of course, this varies from currency to currency, as well as at different times of the day, but I think you can see my point here, what I'm trying to say regarding the amount of movement that often and usually does take place inside individual candles, and in particular during the course of a single day, which is what most of us retail traders, generally speaking, tend to trade. I think that's fair to say. Most of us are just day traders, generally speaking. Now, how can this help us? Well, you know, for me, it's important to at least be aware of this, because depending on your type of strategy, you know, it can mean a fluctuation in price movement in your position after you've put a trade on. And this is where a lot of people, not just beginners, okay, not just beginners, but a lot of people often close the position down that they've taken when they see their profit loss indicator turn red as the open position goes into drawdown. Now, you know, I'm not saying you shouldn't close your position down. I'm not getting into details here. I'm just talking about time frames and how there's a lot of fluctuation in movement. It's something you need to be aware of, particularly down the line if you're a beginner. And if you're not a beginner, you know what I'm talking about. But, you know, at the end of the day, if you've done your analysis well and followed your own trading plan and strategy and stuck to the rules that you have set for yourself and your particular strategy, whatever that may be, then hopefully the outcome will be in your favour. And if not, then money management, which you should also be employing, should protect you to keep your losses to a minimum. Alright? And that will keep you trading or spread betting long term by not blowing up your account, which is what most retail traders do, don't they? You know, we know it's 95% lose, don't they? They blow up their account in the first couple of months or something, whatever the statistics are. That's why you should not risk too much, and the rough guide is to risk no more than 1%. Some say even less than that, but you know, that's difficult to do. To risk no more than 1% can be difficult with, you know, a small beginner account. If you've only got £300, £400, £500, to risk no more than 1% is a very difficult, sometimes difficult thing to do. You know, the stop loss is often more than 1%, isn't it? You're talking about £5 on £500, aren't you, or $500? But the golden rule is this: don't play with more than you can afford to lose, okay? So just remember that. So if you've got money in there, then hopefully you can afford to lose it, because there's a good chance that you will if you're getting started, unless you're really careful, and even then, you know, who knows. But that's another video. I'm going off the track a little bit here. Point is, by looking at time frames that are higher than what we are actually going to enter the market on first, can give us a general overall direction, a general trend or bias to that particular currency pair or market. Okay, so look, just let's take a look at the, just as a quick example, take a look at the British pound Aussie dollar on the 1 hour time frame. Okay, now we can see this pair clearly in a downward trend. I mean, most of us can just sort of see it's going down anyway, you know, during this time period on this time frame. But once you start adding some things, you know, it can be confirmed by the use of added trend lines like this, and or moving averages of various lengths like this, which I'm not going to get into depth here. I'll talk about that, and I'm going to be putting up more videos about all these things in due course. Being aware of this can help us to look for selling opportunities, not only on this particular time frame, which is the hourly time frame here, but also on lower time frames as well, such as the 15-minute time frame, for example, and also the 5-minute time frame. So having that general trend on the higher time frame can give us a general bias when it moves again in our favour on the lower time frames, help us to get in and take our position. Your entry on these lower time frames would also be signalled by trend lines, moving averages, and possibly other indicators of your choice too, if you choose to use them. Personally, I like to keep it as simple as possible, as too much really can be too much. Now, in conjunction with these indicators, for me personally, I like to use some sort of individual candlestick formation or combination of candlesticks to help to confirm and verify the signal further. It's just a little bit extra. I'll be adding more video content on the most powerful, or what are considered to be the most powerful candlesticks and candlestick patterns and formations soon, so be sure to watch out for that, okay? So before opening any position, your technical analysis should incorporate various time frames to give you a general bias or trend to base your trade entry upon. Okay, now in my personal experience, I've been doing this for a long time, about 12 years now, on and off, in the Forex betting, spread betting. Applying technical analysis this way is of great benefit, and it's crucial to long-term success. I know it's kept me going, and I've made more money this way when I've started to really look at the structure and a bird's eye view, so to speak, of what the positions I'm going to take. I can't emphasize this enough. Deciding what are the best time frames for your analysis and entry really comes down to your individual personality type and how you want to trade, such as short term or long term, which I'll discuss in a moment. Now, some general points to consider are: the higher time frames, such as the monthly, weekly and daily time frames, give us the general flow or direction of the market. Okay, these higher time frames are generally looked at and used by the large financial institutions who have got millions and millions, hedge funds and even banks for their positions. So following them would be a very good idea, but they are often slow burners. It's a long-term thing. These are usually for those of you who might think about keeping positions open for days, weeks and even months, and in some cases years if you choose to. Okay, also, the higher the time frame, the more significant the pattern or signal, such as a double top or head and shoulders, for example, among many different types of patterns. But the stop loss might need to be further away, and therefore the potential to lose more if you get stopped out, although greater the possible reward and potential gain if you get it right. This is the thing, if you're trading the higher time frames, monthly, weekly and even the daily a little bit, sometimes your stop loss has got to be further away because you're dealing with a larger movement. Okay, so the stop loss, you put it at the previous swing high, or whatever. I won't get into that now, but it generally means that your stop loss, if you're trading the higher time frames, it generally means that your stop loss needs to be a little further away, which means you could lose more if it goes wrong. Okay, but often if you're trading those higher time frames, you're looking for a longer move as well, so it's all relative. It all depends on how much money you've got, basically, to be honest with you. Another point to consider is don't look at time frames that are too far apart. There's really no point, okay, looking at the monthly or weekly time frames if you're trading the 5 minute or the 1 minute time frames. Okay, there's just no reason for that. Okay, because they're just too far apart. Time frames that are so far apart are really, in my opinion, meaningless. They'll more than likely produce conflicting signals, which would of course be very confusing as well as unreliable. Okay, so don't read and look at time frames that are too far apart. Good time frame combinations are in 2s and 3s. This is a general rule that I like to follow, and it works for me now, and it has done for a long time. With this in mind, the higher time frames are for the general direction or structure, I'm not talking about the higher highs. I'm talking about when you've got a combination of time frames, 2 or 3 time frames, which we'll get into in a minute. The higher time frames from your little combination of time frames are for the general direction or structure of the currency pair, with the lowest time frame being your entry time frame. Okay, so for example, the monthly, weekly and daily time frames are a good combination together, in my opinion, for those of you who want to trade a bit longer term and leave positions open for a little bit longer, perhaps, like I've said, days, weeks, and in some cases months or more. This type of trading is ideally suited for someone who is generally patient and relaxed in nature and possibly got a little bit more funds, and somebody who doesn't want to spend every day at the charts, okay, or simply just doesn't have the time to. Alright, this type of trading is generally known as swing trading, where we're generally looking to get in early on a new trend for a big move to profit from lots of pips. Another good combination would be the daily, the 4-hour and hourly time frames, in my opinion, for those of you who don't want to hold positions overnight but still can if you feel the need to. This is also ideally suited for someone generally relaxed and patient in nature and possibly has less time or just doesn't want to spend all day at the charts. This type of trading is known as day trading or intraday trading, where a position is opened and closed in the same day, although occasionally it could be left open overnight if you chose to let your profits run. Okay, if you thought that was an option, but you'd have to look at the costs of your broker to keep your positions overnight, and I think it's a percentage. You'd have to look into that. For those of you who want to trade shorter term, which is considered as scalping, where positions would only last anything from say around 5 to 60 minutes or so, then possibly the hourly time frame, the 15-minute time frame and 5-minute time frames can be used together to find setups with that in mind. Okay, also another combination for scalping might be the 30-minute with the 15-minute and either the 5, the 2 or 1 minute time frames. Okay, as for the other styles, the higher time frames here are for your general analysis of the market structure or trend at that time, with the lowest time frames for your entry into the market. Okay, scalping is a term for short-term trading. It basically means taking a bit off the top quickly. Scalping the lower time frames is more suited for those who are maybe a little more energetic and looking for a little more action. But please take note here, you can get caught out really quick. If you're just starting out, then be very careful with scalping. There's many beginners, and I used to do this when I first started, and you'll hear a lot of people say this as well. You can take revenge trades in an effort to recoup any losses that you've incurred, you've lost. Then you're trying to, I've got to get that money back, and you jump in again, and it's a slow, slippery downhill slope. Short-term scalping the lower time frames requires you to be switched on, unemotional and disciplined, as you can very easily get drawn in, as I've said, almost like a boxer getting drawn into a punching match with a good close-up fighter. Okay, so beware, especially when you're already up against the spread from the beginning. You've got to make up the spread before you even start making a profit. And on top of that, it can go very quickly, in the other direction, and before you know it, it's all going wrong, and then you start panicking, possibly. So please take note of this. Okay, scalping, you've got to be very careful. Look, in short, being aware of various time frames and combining them to be a part of your overall trading plan and strategy can significantly help you to make better trading choices to put you in a far better position from the very start of your trade, whether you're a scalper, a day trader or swing trader, whatever style you want to do, whatever type of personality you are, whether you're trading the long term or the short term, whatever style you choose, with practice and experience, hopefully you too can become one of the select few of consistently profitable traders by combining time frames in your technical analysis. Now, I just want to say this video has been a general explanation for trading the trend, and I'll be adding a lot more in-depth content for trend trading soon, as well as for swing trading, okay, for those large market moves and large profits. I sincerely hope this has given you some form of direction, pardon the pun, regarding time frames, and if it has, please don't forget to give it a thumbs up and subscribe to the channel. You know, if you can, I'd appreciate your support. Not forgetting, of course, to click that little notification bell to make sure you don't miss my latest videos. Thanks for watching, guys. Trade safe and good luck in the markets. All the best.